Hey everyone, welcome back to The Explainer. I am absolutely thrilled to have you here today because we're looking at a massive, completely hidden structural shift happening right now in global finance. Okay, so we all hear about the daily price of gold or silver in the news, right? But beneath the surface of those flashing ticker symbols, a profound and honestly kind of secretive geographical transition is occurring. We're talking about the transition of the physical bullion trade out of traditional Western markets and straight into emerging Eastern hubs. It's this fascinating story of paper promises versus physical reality, and it's a real game changer. To really wrap our heads around the scale of what's happening, just get a load of this staggering number. In just one recent February, 39 million ounces of silver left the exchange. And we are not talking about digital numbers moving around on a screen. That is nearly 2 million pounds of physical silver. To put that into perspective, that's roughly the weight of two fully loaded Boeing 747s, literally loaded onto trucks and driven away. This represented a whopping 160% of what regular deliveries could explain alone. And look, this isn't some isolated one-off incident. Ever since 2020, we're seeing physical deliveries of precious metals at historically unprecedented levels. No way around it, it's a massive shift. Now, for decades, the global commodities market operated largely on a system of paper warrants. Basically, if you bought silver, you accepted a warrant, a piece of paper that essentially just said you owned the silver sitting quietly in some vault. And you know what? Everyone was totally happy to just trade that paper back and forth. No one actually stood for delivery, mostly because, well, moving heavy metal is really expensive and incredibly time-consuming. It's kind of like a high-stakes game of musical chairs, where everyone is having a great time as long as the music plays. But suddenly, traders are stopping the music. They're saying, actually, scratch that, no thank you to the paper, please send me the actual numbered bars, which brings us to the absolute central mystery of our explainer today. If the norm for decades was just to comfortably hold a paper warrant, who are the massive, wildly well-funded buyers suddenly refusing that paper? Who is out there demanding the actual physical metal? I mean, who is literally backing up the trucks and draining these Western exchanges? Section 1. The paper market disconnect. To solve this mystery, we first really need to understand the environment these buyers are operating in. Let's take a quick look at how the Western financial system actually handles these commodities. Back in 1971, the U.S. removed the dollar from the gold standard. Shortly after that, in 1974, the Commodity Act was passed. Now, the original intent here was incredibly practical. It was designed to help actual producers, your farmers, your miners, hedge against price risks so they wouldn't just go out of business due to seasonal fluctuations. Makes sense, right? But look at where we are today. That well-intentioned, practical system has completely morphed into a highly financialized market. And the reality of that transformation is just staggering. Today, a massive 98% of the futures market consists entirely of speculative trading. We're talking about algorithmic traders, hedge funds, and bullion banks essentially just placing bets on paper prices. Only a tiny fraction, like roughly 2%, involves legitimate hedgers who actually produce or physically consume the metals. It's almost entirely speculation now. So what does this all mean? The absolutely crucial point here is that because of this immense volume of speculative paper trading, the price you see on your screen often just reacts to things like Federal Reserve interest rate expectations, currency movements, or just general market vibes. It completely ignores the robust underlying physical demand. The paper price can completely detach from the physical reality of who is actually buying the metal. Section 2. The ultimate insiders. Now that we see just how distorted the paper market is, let's pivot right back to our central mystery. Who is looking past the paper prices? Well, the prime suspects taking physical delivery are sovereign nations and central banks. But wait, think about this irony for just a second. Why are central banks, the literal entities responsible for printing fiat currency, aggressively hoarding physical gold year after year? I mean, these are the institutions with the absolute best economic data in the world. They know exactly what's happening in the global economy, and they are quietly but aggressively buying up the one asset they physically cannot print. Analysts observing this trend suggest central banks are quietly positioning their balance sheets for a highly uncertain future. They're looking at a dashboard of mounting structural pressures, skyrocketing sovereign debt, persistent budget deficits, complex demographic challenges, and some really intense geopolitical competition. And simultaneously, they're navigating a massive digital shift, experimenting with central bank digital currencies and whole new payment infrastructures. Basically, they're preparing for a profound modernization of global finance. So in the face of all those modern, incredibly complex risks, the appeal of physical gold becomes crystal clear. It carries zero counterparty risk. Unlike a digital asset or fiat currency or a treasury bond, Physical gold's value absolutely does not rely on the financial health, the stability, or the promises of any government, bank, or corporation. If you hold the physical bar, you hold the wealth. It really is just that simple. Section 3. The Eastward Bullion Shift. Because physical possession is becoming so incredibly paramount, it's triggering something huge. For decades and decades, Western hubs like London and New York completely dominated global bullion pricing and custody. They ran the whole show. But today, we are witnessing a deliberate, massive transition of the physical bullion trade right out of the West. A rapid, state-of-the-art expansion of physical trading infrastructure is spreading rapidly across Asia and the Middle East. They aren't just buying up the metal, they are building the massive ecosystems to store and trade it locally. And we aren't just talking about one or two isolated vaults here. We're looking at a formidable, highly coordinated network. China is strengthening the Shanghai Gold Exchange and utilizing Hong Kong's multi-jurisdictional vaults. Singapore is rolling out a brand new physical delivery market. We're seeing major expansions into the United Arab Emirates, Saudi Arabia, Mumbai, Brazil, and even a new BRICS vault in St. Petersburg. This is a sprawling network of clearing and vaulting systems, intentionally designed to challenge Western financial institutions. A massive driver behind the whole shebang is China. Market observers note that China is aggressively expanding this physical gold infrastructure to increase global confidence in its own currency, the renminbi. By accumulating substantial gold reserves and creating these local physical delivery markets, they're aiming to give the renminbi a much, much larger international role, which of course presents a direct structural challenge to traditional US dollar dominance. Section 4. The New Global Financial Architecture. So what's the ultimate geopolitical impact of this quiet, eastward shift of physical wealth? Well, this process is leading to what analysts are calling the regionalization of commodities. It's basically a three-step playbook. Step 1, central banks accumulate the physical metal, steadily draining Western exchanges. Step 2, the custody of that metal officially moves into these brand new Eastern and BRICS-aligned vaults. And Step 3, the eventual emergence of multiple regional pricing centers. The future likely involves these different regional centers actively competing for influence, which will permanently alter how strategic commodities are valued and traded internationally. Basically, the West will no longer hold a monopoly on the price. There's a key quote from the source material that perfectly hits the nail on the head regarding everything we've explored today. Quote, "The story is no longer simply about the daily price of gold. It is about who is accumulating physical metal, where that metal is moving, and how the global financial architecture itself may be quietly changing." End quote. It's a great reminder for us to look past the distraction of the highly financialized, paper-driven daily ticker and focus on the physical reality happening right beneath our feet. And that leaves us with this final, absolutely vital question to ponder. As this vast amount of physical wealth continues its steady migration from west to east, setting up entirely new networks of influence, how will this shifting financial architecture impact the future of your wealth, your purchasing power, and the broader landscape of global trade? The rules of the game are clearly changing, and anyone paying attention needs to keep their eyes exactly on where the actual physical metal is going. Thank you so much for joining me for this explainer. I really hope it brought some brilliant clarity to a very complex topic.